Why do most investors avoid trading and prefer investment? Can you be a millionaire by just investing a few $100s? Hey, what's up everybody? This is Unravel, where knowledge is power. Today, we'll debunk the myths and lay out the difference between investing and trading. As per definition, trading, in simple terms, is an act of buying and selling an investment. And investing means allocating money with a hope of a positive return in the future. There's not much technical difference between them. The difference is how they seek and pursue the goal of making a profit. An investor is someone who spends money on an asset with the hope for it to grow over time to make a profit. On the other hand, a trader is someone who buys and sells stocks frequently. The main distinction between the two is that one relies on long-term strategy and growth, while the latter makes a profit on short-term and quick turnaround. There are two main areas where trading differs from investing. 1. The timing of trades, and 2. The analysis methodology. Bringing in the factor of timing of trades, investments are often held for a long time. It can be years or a decade before it's sold. When you buy a stock, you're betting that it will increase in value over time, while there are day-to-day fluctuations in the stock prices. Investors hold their share for years as they focus on long-term gains. Trading, on the other hand, involves frequent transactions to take advantage of short-term price fluctuations. An example is day trading. It involves buying and selling stocks on the same day, while swing trading is a tad bit longer process that can take a few days, weeks, or even a year. There are several ways of trading, and all of them involve a short time frame, sometimes even seconds. Apart from the time frame, the analysis technique has a huge difference. But to fully understand the analysis, we first have to know the difference between a stock price and an intrinsic value. The stock price is determined by the demand. For instance, if the demand for a stock is high and people are buying more of it, it will increase the price of the stock. And similarly, if the demand is low and a significant number of people are selling it, the stock price will come down. Beyond the stock price is the true value of the stock, which we call intrinsic value. And only predictions can be made about it by understanding the financial metrics of the company. In the real world, human factors and emotions such as fear and greed can cause the stock price to differentiate from its intrinsic value. There are two methods investors use. One approach is passive investing. These investors ignore the short-term volatility in the stock price and focus on the rise in intrinsic value. Even if they buy an overpriced stock by chance, they'll gain much more due to the long-term benefits. Another type of investor is the active investor. They buy the stock when it's worth lower than its true value. Traders, on the other hand, only care about the stock price. Unlike investors, they don't rely on intrinsic value, and many even trade in thousands of dollars without even knowing what the company does. They only take advantage of the change in price and trends to make a quick profit. Due to this reason, traders usually rely on technical indicators that include historical prices, trends, and patterns, followed by the stock rather than the company's fundamentals and intrinsic value. Traders focus on snippets of information about the company, rather than in-depth knowledge and analysis of a company. Trading operates at a different mindset compared to investing and is more competitive and fast-paced. The nature of trading is more lucrative to younger people who have time on their hands. It provides them the thrill of quick trades and fast payoffs. There's also a growing trend we see online, where the millionaires explain how they went from broke to rich with just a few $100 trading strategies. That might make us think that trading is easy and can make you a lot of wealth, but in reality, trading possesses a lot of risks. Even after a considerable amount of time and effort, some traders only make a fraction of the profits. Things usually do not go well for amateur traders who can't cope with the tempo of the market and make quick decisions. Meanwhile, it's not impossible to make a living with trading stocks. Some people earn well, giving full time to trading, but Trading also involves huge unpredictable risks. Any investor will tell you that investing is the way to go for a person who wants to invest his money. With comprehensive research and holding on to an asset for a long time, you'll benefit from the economic and stock market growth. With investing, the risks are calculated unlike trading. Now, of course, you won't get any rush and excitement as you would in trading, but it's probably for the best. Investing is a win-win proven strategy whose benefits outrun trading. With a little bit of patience and research, you can earn yourself a fortune with your investment.